This is Chip Cummings, and you're watching the Mortgage Minute. Let's go! Hi, I'm Chip Cummings, and welcome to this week's Mortgage Minute. News you can use. Well, it's summertime. Fun in the sun, the kids are out of school, and margarita time. I don't know if they're necessarily in that order, but there's been a lot going on in the mortgage marketplace in the last week. Let's take a look at the numbers. Well, I hope you had a good weekend. My staff asked me today why I showed up to work in shades, and I said, because I can. You see, the sun's shining here for a change, and the weather's warmed up, but there is no warmth in the mortgage market. That's right. This week, we saw some major increases in the 30-year fixed rate. In fact, we saw a 23 basis point bump. That's the largest we've seen, and it's an 8-month high as the 30-year fixed rate average nationwide, according to Freddie Mac, went up to 6.32%. The 15-year followed along with an increase up to 5.93%. The 1-1 arm went to 5.09%, and the 5-1 arm is also up at 5.70%. Those are some big increases, and those were predicated on the fact that the Fed is not likely to do anything with interest rates or, if necessary, raise interest rates in order to keep inflation in check. So, what's a poor mortgage person to do? Well, that's the topic of today's discussion. CNN just released a figure that indicated that 2 million people are going to be facing foreclosure in the next 2 years. That's right, 2 million. Did you hear me? That means 1 out of every 11 households will be touched by some sort of foreclosure action. Now, I don't know about you, but that's not only a scary number, but it also opens up a huge opportunity, an opportunity for you to take advantage of the marketplace. You see, according to recent statistics, we know that the mortgage industry has shrank by about 56%. That's right, 56% of the participants are no longer playing the game. Well, the volume has not gone down 56%. That means there's an unprecedented opportunity for you to capitalize in the marketplace, but only if you know which target market to hit. Foreclosures is big business, folks, big business. Not just for the people that are getting foreclosed on and the people that are helping them out, but for investors, for real estate agents, for fix-up companies, and for lenders. That's right, for lenders. And for even mortgage insurance companies. Catch this, we now have mortgage insurance companies that are writing checks to borrowers in order to keep them in their homes. That's right, it was released last week that private insurers are actually writing checks to catch people up on their back payments because it's cheaper than actually foreclosing on the home. Now, why didn't we think of that? We can actually put some piggybacks and put people into some FHA products that make a whole heck of a lot more sense. But from a practical standpoint, how do you take advantage of these situations? Well, here's 2 suggestions for you. Number 1, team up with a real estate agent that specializes in foreclosure properties. Schedule some type of bus tour or open house tour where you can take investors and other interested parties to the different foreclosure properties that this agent and others have to offer. Therefore, you can generate not only interest in those properties, but obviously fill up your pipeline at the same time. A second solution has to do with serving the community. That's right, set up a community hotline number, a foreclosure hotline. Team up with community groups, with your local newspaper, the press, the radio stations. Get everybody involved. It'll cost you a phone number or an answering service, maybe about $100 a month, to be able to answer people's questions about foreclosure. The funny thing is we're finding about 27% of the people that call into those hotlines actually can be helped and refinanced out of their current situation. Can't help everybody, but we didn't create the situation, so let's not bury ourselves in it. Well, we can't let another week go by without talking about the U.S. bailout program. That's right, Congress to the rescue again. Now, it's estimated by the Congressional Budget Office that the latest proposal for the U.S. Senate in terms of a foreclosure rescue bill will actually cost Freddie Mac and Fannie Mae about $9 billion over the next 10 years. That's right, $9 billion. Now, most of this comes by way of mortgage insurance and state housing development grants and rescue grants to borrowers to the tune of $710 million per year. Well, they're in a little pickle, and that's going to be a very expensive solution to an already exacerbated problem. And U.S. home buyers and taxpayers are going to be the ones that fit the bill. I don't know about you, but that leaves a bad taste in my mouth because I'm not in any mood right now to keep bailing people out. Well, a lot of people are asking me right now, what are some of the strongest markets out there in the marketplace? And having just come from Las Vegas, I can tell you that Nevada is not one of them. Arizona, Southern California, they're still struggling. But from a demographic standpoint, there are some bright spots. In a test that was conducted out on the eastern seaboard, 2,800 loans were given to illegal immigrants. That's right, illegal immigrants. And they found that out of those 2,800 loans, only 27 of them went bad. That's less than 1%, far below the national average. Now, the kicker is that they have to show that they've filed their taxes, that they've got an individual taxpayer ID number, and they have decent credit. Now, there are a lot of reasons for this, but one of the biggest speculations is that people in that group are not buying a home for a profit. They're actually buying it to live in. Wow, what a concept. Unfortunately, I'm one of those that agree that illegal immigrants should not be getting loans, period. How dumb is this? Get legal. I guarantee you that they would still be paying the loans the same way if they were legal immigrants as opposed to illegal immigrants. What if they get deported? How are you going to collect on them then? Well, as we wrap up this week, we've got one from the I just can't believe it department. That's right. Imagine if you ran a bank and you could give your friends and family special discounts on rates and terms and costs. Well, that's exactly what's going on in this story coming out of Washington. Except this time, the friends and family turn out to be high-ranking officials. That's right. The U.S. Senate banking chair, Christopher Dodd, as well as other prominent Democrats, and even the former head of HUD himself, Alphonso Jackson, and even the former Secretary of Health and Human Services, Donna Shalala, have been caught in what's called a Friends of Angelo program. That's right. Friends of Angelo participated in this program that gave them preferential treatment when it came to getting loans at Countrywide, with discounted interest rates, waived points, and costs. And I'm telling you, they added up to tens of thousands of dollars. Now, I don't know about you, but I'd be looking at whether or not that influenced any decisions on the part of some of those officials. I would also think that Alphonso Jackson would be in a good enough position to have gotten himself a HUD loan. Something to think about this week as you enjoy the rest of your fun in the sun. I tell you, it's time for me to go out and have a little fun in the sun myself. So until next week, this is Chip Cummings for the Mortgage Minute and Mortgage Power Network saying, keep them straight, hit them heavy, and I'll see you next time.